Happy Wednesday. Welcome back to another episode of the Educated Homebuyer Live. It's Wednesday. It is time for Josh and I to answer your mortgage and real estate related questions, help you become the educated home buyer. So Josh, went back to an intro, bit repetitive on the music, but that's what you get for free music. We got a little bit of surprise coming up here as we discuss the slides. But Josh, the big news this week, rates. Rates have actually come down a little bit since last week. You'll dig into those details here as we look at the slides. But what's the big news since last Wednesday?
No big news. Well, we had some big news over the weekend, and thankfully it avoided a crisis of some sort. So that's not our topic. Politics aren't our topic, but that was the big news, Jeb. Really, we're kind of in a little bit of a lull. We hit that PCE, CPI, NFP 10-day period or so. So we're now waiting, 2 weeks? 2 weeks from today, we get another Fed meeting, and they're expected to do nothing, but likely will change the tone of both the prepared remarks from Powell and his responses to some of the questions.
Remind me, was last Thursday not the CPI data? Was it the following week? Was it the previous week before that? Or was it last week? It was last week.
Last week.
Yeah. So last week after the show.
It was the day after the show.
Yeah.
I got my days off. I'm old. I'm getting.
Yeah. So CPI came in better than expected. Because of that, we saw the 10-year react really positively. We've seen mortgage-backed securities, trade favorably with that. We've seen a little bit of change in rates. Is that fair to say?
Yeah. And the big thing is we ran down right under 419 is an important level. And we got under it for a few minutes and then closed right above it. And then today we finally saw that break through it. It wasn't like some big thrust downwards. I think we ended at like 414. We'll see when we get to the slide. But it tells us that we should make a run down to 407. And if and when that gives way, there's another 0.25% in rate improvement before we get down to serious resistance.
All right, good stuff. So with that, let's take a look into the charts. While we're doing that, if you have questions about mortgage, about real estate, be sure to put them in the chat. And when we're done with the slides, updating you on everything that's happening in the economy, we'll dive into those questions and help you, again, become educated home buyers. So Josh, as we always do, we look at inventory first. So 652,000 homes on the market at the moment. That's actually a decrease week over week. The first decrease that we've seen actually all year at this rate. And the primary reason for that is because holiday week, right? It's affecting the numbers. But with that, 38.5% more than last year. We got inventory up in every state now. Florida, Texas, Oklahoma, Arkansas, and Idaho have more unsold inventory than 2019. And we'll talk about that as we dive into the details here. But that's going to take us into local data. So here, if you're local to Orange County, Huntington Beach, we always look at these charts. Orange County sitting at 3280. That's a 6.28% increase week over week. Huntington Beach, a 9% increase week over week, sitting at 200 homes. Again, why? We essentially had 2 weeks of inventory coming to the market in 1 week because people skipped out over the holiday season, July 4th. Most people aren't listing their homes a couple days before, a couple days after. So a lot of that data pushes to the following week. And that's my guess as to why we're seeing the increases that the percentage increases that we're seeing here on those charts. This is from Calculated Risk. We always like to look at this. I think this is the third week of June. So this is getting towards the end of June. We're going to be looking at July data here real soon. But again, this is active inventory going back to 2019, shows us year over year, 2019 levels. Always like to pay attention to what's happening, but context is important. And that's why the 2019 levels are super, super important there. Again, Josh, the one that stands out week over week over week seems to be that Jacksonville market. It's the one that up almost 100% year over year and up nearly 45% since 2019, where everything else is up year over year. But essentially down when you're looking at those 2019 levels.
In this list, Phoenix is interesting also, sitting there at 18% versus 2019 and 57% year over year. So definitely more inventory coming on the market. It's a more volatile market, but it's a big and popular market. So interesting to see that.
It's funny. And I was just at a conference with some agents across the country talking about different markets. And they were like, hey, listen, yeah, we're seeing that, but there are pockets within our market that are still very crazy, that, demand is still high, property's moving really quickly. So we always talk about real estate being local. So even if you're in one of these markets, pay attention to where you're trying to buy, because it could differ considerably.
Well, it's probably, I mean, it would be interesting to have one of those Phoenix experts on. I would bet it's similar to what we're seeing here. The entry level stuff is still tight, and the pricier stuff is sitting a little longer.
Exactly. New listings. So new listings, 57,000 new listings unsold this week, which included the long holiday weekend. Only 11,000 immediate sales in that time, 68,000 total sellers, 6% fewer than the same week in 2023. 16% of the new listings getting offers and going into contract immediately, which essentially illustrates that we have very slow buyer demand at the moment. Immediate sales percentage has been declining since early May, and that's going to push us into looking at new listings. Same chart, same source rather, calculated risk. Look at the 2019. Look at where we are now, year over year increases. You've got some year over year decreases in there, right? So new listings at the moment are trending near all-time lows still. So you can't have distressed sales. You can't have foreclosures. You can't have big price drops when you got less new listings coming to the market. So why is inventory growing? Inventory is growing because homes are sitting on the market longer. They're just not going under contract quite as fast. A weekly change again went from 652,573 to 651,453. As I mentioned, a decline. Our peak was that 652 from last week. My guess is another week we're going to get back over that because things are going to normalize a little bit. But weekly new contracts. So weekly new contracts pending, 58,000 new contracts for single family homes. It's about the same as the previous two July holidays in 2022 and 2023. 382,000 single family homes in contract, which is 1% more than last year. That's going to take us into median home price sitting just under 450,000. That's down 1% for the week and unchanged from last year. Median price of new listings is sitting at 404,900. And then we have price reductions, price cuts sitting at 38.3%, which essentially is flatline from the previous week. So with that, Josh, we're going to look at a couple of people here. Why are we looking at these people? Who that doesn't look like you.
This lovely couple here.
He looks way more fit than you.
He's obviously a jacked man. He's more tattooed than me as well. These guys got into their first home. They had started down the path with another lender. They're watchers of your channel, Jeb, watchers of the podcast, and reached out and went through it. And it was definitely a journey. Self-employed, some moving parts there, but we got them in, and they're in an awesome home in Texas for them and their kids to start building their little family nest there. And then earlier today, Bronson, another viewer here down in San Diego, California, bought this bitchin' pool home. I almost wanted to just show a picture of the pool. The pool is awesome. You can see it's in Santee, California, outside of San Diego. You got the beautiful hills, you got the wonderful weather, you got the pool. So
good stuff.
Just happy to celebrate these people. Congratulations to both of you in terms of getting into your home.
Yeah, and that's something we want to do. If we've helped you with a loan, helped you buy real estate personally, if I've helped you, and or if I've referred you to somebody and you've bought real estate and you're willing to be on here and let us show you, send it to us. We want to show you, on the show. So, this is that call to action for you guys to reach out and provide us that info, because we'd love to show people that it actually can be done. So, Josh, we're looking at inflation. We talked about this a moment ago briefly, but what did we actually see?
Yeah, so we don't have a whole heck of a lot of new data. My brain was telling me that CPI was last Wednesday before we came on. You're right, it was the day after. So CPI came in lighter than expected. We sort of previewed it last week, saying that we thought the core was going to be flat and the headline would be down a little bit. Both of them came in about 0.1% better than expected. The market reacted positively based off of that. We then had PPI on Friday, Jeb, and PPI came in a little bit hotter than expected, but there are components inside of PPI that do translate and carry over into the PCE data, which is the Fed's preferred measure of inflation. And all of those components that translate over were well contained. So although the number that was announced was high, it's a volatile index, and it didn't, the elements that carry over to PCE, which is what the Fed cares about, were not there. So I wanted to throw this in here, and we'll track this just week over week. Looking at, you can see the month over month figure and the inflation year over year percentage change. This is the Nowcast. I think it's the Cleveland Fed that does this. So if we look at the year over year projections for July are CPI and core CPI at 3 and 3.3, and then PCE, which is the Fed's preferred measure, both headline and core at 2.47. So moving in the right direction. And relative to the Nowcasts last month, Jeb, both of them were high. They were forecasting higher inflation than we saw both on CPI and PCE. So let's hope that they continue to be overestimating those numbers and we see inflation moderating. Haven't shown this in a while because it ends up being really volatile, but the Truflation, this ends up over time having like a 98% correlation to our CPI, and it seems to get there faster. We talk about some of the lags in the shelter costs not carrying through. This picks it up faster, but you can see this is really volatile. It's jumped on us a couple times. The trend is absolutely down. It's at 1.89%, so well below the Fed's end target of 2%. We'll see how long it takes for both CPI and PCE to catch up to that. What does that mean right now? Heard someone talking earlier today, Jeb, saying, well, the markets are now projecting 3 cuts before the end of the year. I'm not sure that I agree with that. Well, let's look at what the markets are saying. They're projecting that in 2 weeks, when the Fed meets, absolutely nothing, 96.3% chance that they leave things exactly where they're at. The next meeting, 97.3% chance that they're going to cut 0.25%. So that's September. That's before the election. We've talked about this 50 times on the show this year, that we didn't necessarily expect them to do something before the election, but it looks like that's going to happen. 67% chance that there will be a second cut a couple days after the election. And then we have a 56% chance that we have another cut in December. So when you look at that, I mean, yeah, the odds are slightly in favor of those second and third cuts, but it's almost a coin toss there. I wouldn't weigh too much into it. The data coming the rest of the year is going to tell us what happens. If inflation keeps moderating and unemployment keeps ticking up, we're going to get 3 cuts. If you see that stall out or heaven forbid go the wrong direction, we could easily see this reverse on us just like it did earlier in the year. So this is a chart we like to look at, and we've got some questions here, Jeb, and let's just answer them right now. So Sport Trick says, when's the best time? That wasn't the one I was looking for. We got Jermaine wants to know, hey, our close days within the first week of September. When will the best time to lock in the interest rate? So we always want to look at this. The technical analysis is like counting cards. It lets you know when the odds are in your favor. It does not guarantee you what's going to happen tomorrow. It does not give us a crystal ball, but we've been watching this green down channel for some time. We've watched these layers of resistance on the way down. They're technically support, but for us, since we want yields lower, we consider them resistance, and we broke through that 4.19. We're in this green channel, and we are likely, as you see, when we touch the top, we are very likely to come down and touch the bottom of that channel. And that tells us as time goes by and we slowly inch down, I think we're going to make a run to that 406, 407 before we see what happens. Those down,
we're talking
channels,
the 10-year. We're not talking rates here, guys. Yeah.
On the 10-year. Yeah, 100%, not interest rates. But mortgage-backed securities and interest rates, they follow this very, very closely. You can make an argument that over the last year or two, they follow more closely the 5 or the 7 year. The 10 year is what we look at. And what we're saying here is when you're in one of these trends, either on the upside or the downside, you are more likely to get to one end of that range and stay within the range than break out. At some point, we may break out. But if I'm looking for that September timeframe, I'm probably going to try and get myself another week, 10 days, and see if we get down and touch the bottom of this range. And when I see that, I would be real tempted to lock at that point, just because we are more likely to then make a run back up at the top of the channel, even though the direction for rates is in our favor. So with that, where are rates? under 7% for the first time in a long time on the 30-year fixed, 6.25 or so FHA and VA per Mortgage News Daily. As always, we can do a little bit better than this for well-qualified borrowers. So don't look at this and go, that is what it is. But these are the best online published numbers that you can look at that are adjusted daily, that are realistic and not liar numbers. So with that, the other thing I want to point out in there, Jeb, those little green boxes, we are below where we were a year ago. Some of that was because this week last year rates went up, and this week this year rates went down. So we want to continue seeing those week over week, day over day, month over month, year over year figures coming down, and hopefully we're near the low end of that range. So if we get to 6.61, that's the 30 or the 52-week low on the 30-year. So it'll be interesting to see if we get there or when we get there and how much we can go below it.
All right, good stuff, guys. So if Josh can be of assistance to you, you need a quote, you need pre-approval, you want to compare, you want to shop, whatever, use that link, scroll in the bottom of the screen there. It's also in the description of the video, and you can get in touch with Josh, our team, and, at least make sure you're getting the deal that you think you're getting. And if not, get a better deal. And with that, we'd love the opportunity to help. So do that. Now, what I have going on next, Josh, is a video that Josh and I recorded back in 2014. So back in 2014, guys, just a little
10 years
note.
ago.
I'm not going to show you the entire video because it would be tough for Josh and I to watch it, quite frankly. But I had someone telling me, hey, Jeb, you got to get on video. Video is where it's going, 2014. And I was fighting it with everything I had in my body because, quite frankly, I didn't think I was meant for video. Still don't think it to some degree, but back then really didn't think it. So Josh and I decided we're going to go and we're going to film a video in a barn. We were in a barn. This is not a green screen. It might look like a green screen, guys. It's just your eyes playing tricks on you. I think I can click this, Josh, and play it if I'm guys. So this is going to be tough. Can I click it, Josh? Is that doable? Can I actually click the video?
Is it just going to be a damn picture? We can't even.
It won't let me click it.
Why does it let you import a video?
I don't know. It lets me play it on the actual slides, but not in here.
That's annoying. That's annoying.
All right. Well, guys, I built that all up for absolutely nothing. So next week I'll have it for you. Yeah, it's I don't know. Maybe by the end of the video we'll have something here tonight. So anyway, we're gonna transition from that, start answering some questions. While Josh is answering some questions tonight, I'm actually going to find a way to import the video so that we can just laugh at Josh and I and have a good time here. So, Josh, we got a lot of questions from Willing. Have you gone through them? Have you?
Yeah, go. Just they're reasonable.
So
we can go with them.
All right, so
we'll start with the one before that because it's a two-piecer.
All right, so here we go. I'm going to let you read it. Oh, Jesus. Here we go. There you go. Go for it.
If you have a borrower who's been part of a business for 10 years, but just started receiving a salary in January of 2024, can you consider this income to qualify, or do you need 2 years? This is an important question. This comes up often that I get borrowers saying, well, no, I make $10,000 a month W-2, and I have my K-1 income from my S Corp, my C Corp, my LLC, whatever that is. But when you go back in this situation, they had zero W-2 income, zero payroll income before. Many times it was, hey, paid myself $25,000 a year, $35,000 a year through payroll on a W-2. But now starting in January, we shot it to the moon. And the person says, well, I want to use that too, because I'm paying myself that. When we analyze a self-employed borrower, we first look at what you've paid yourself through W-2, then we analyze the tax return, then all of that gets averaged. We don't even use the year to date because we don't have a tax return. There's no cash flow analysis to see that $10,000 was deducted out of the cash flow of the business, because we look at your W-2 pay stub income, then we analyze the tax return and add the cash flow from the business after all of the expenses have been paid per your ownership interest. So if someone gave themselves a big raise from zero to whatever, or from 2,000 to 10,000 just here in January, you're not going to be able to use it.
All right, good stuff. Josh, there's people that want the video. I have a way of importing it, so I'll import it here momentarily. A couple of questions. Danielle says, do you work with USDA loans, Josh?
This is a hot question. As we've expanded around the country, it is a great option. So the answer is yes. We're in about 18 states, actually 19, I believe, Jeb. We added Virginia last week. I think I told you guys, and we are this close to being approved in Nevada. So once we get those approvals, I will add my approvals. We have a team member who can help and be the loan officer on those files in those states while I will be your primary contact. So you get the benefit of me answering your questions, but someone else actually handling the mechanics on the loan. So USDA loans, yes, and it's an awesome program. It's basically an FHA loan with better mortgage insurance.
Good stuff. Sport Trick says, when is the best time to refinance when interest rates start to drop? Question mark. I have a 7.25% interest rate. So Josh, when is the best time?
Well, let's reverse engineer it. Let's say, how much do you have to save to make that make sense? In this instance, let's assume it's a conventional loan. And we just saw per Mortgage News Daily, 6.81 is the rate. Let's say it's 6.75. That's a 0.5% lower in interest rate. You guys have heard us say 1,000 times. What's that rule of thumb? 125,000 divided by your loan amount will tell you how much you need to save. So let's say it's a $250,000 loan. 125,000 divided by 250,000 tells us you have to save 0.5%. So if you could save 0.5%, it makes sense to do it now. So the question becomes, are you certain enough that rates are going to go lower in the near term future? We're in a downtrend that we want to hold off and risk not ringing the cash register and taking the benefit of what's here and now. Most of the advice that I'm giving to clients is go with your gut. You have to make your own decision that you're most comfortable with. But if we can get 0.5%, 0.75%, we locked one this week that it was 1 3/8 lower than their current interest rate on a VA loan. And with that, it was an $800,000 loan. That's like a no-brainer. We're not going to risk that going away and not being able to do it. So what we want to do is do it as close to no cost as possible so that we don't have any sunk cost. And then if 6 months from now, 12 months from now, rates are 0.5% lower again, we can do it again.
Good stuff. Question here from I Think I Knew says, can you refinance if you are doing a 2-1 buy down with FHA? If rates improve, obviously. So Josh, if rates go lower, I've already bought down the rate. Is there an opportunity for me to actually refinance and into another FHA and or something else for that matter?
Absolutely. And this is one of the benefits of a 2-1 buy down versus a permanent buy down. Let's say your doppelganger paid 2 points and bought the rate down 0.5% permanently, whereas you did the 2-1 buy down and 6 months later, rates are now 0.5% lower. In terms of your net tangible benefit calculation for the loan, all we have to show is the note rate. We're not looking at what your bought down rate is. We're saying note rate to note rate. And remember, with a temporary buy down, a 1.0, a 2.1, a 3.2, the funds that pay for that are set in an impound account, and that balance is yours. So we can either use it to pay closing costs, buy the rate down permanently now, or we can do a principal reduction and just have a smaller loan amount.
All right. Love for Puppies says, is a new appraisal always needed for a conventional loan if you bought a new build 6 months ago?
Not always, but
I'm sorry, conventional loan refinance. I missed the keyword there, refinance.
Not always, but if you are going to a new lender, the appraisal has to be ordered according to the appraisal independence requirements and go through an appraisal management company or an appraisal management desk inside of a large lender. So if you're with one lender, so let's say in this situation, new build, if you did the loan with the builder's lender because they gave you $20,000 concession to do it, and now you want to go to your local broker because they have better terms on the refinance, you're going to need a new appraisal. In the situation where we have 2 or 3 lenders that will allow us to, within 12 months, to do a recertification of value on that appraisal and use the same appraisal. So most times, 95 times out of 100, you're going to need a new appraisal.
All right. Just a quick one here, Josh, asking it. I'm closing on a home in 2 weeks with a rate of 6 and 5/8, 6.625 with 0 points. Is it a good rate? So I guess if it was conventional, it'd be a really good rate. If it was FHA or VA, maybe not. So is there anything to add to that context wise?
No, that's essentially the answer. And we also don't know your credit score. If you have a 600 credit score, it's a fantastic rate on an FHA. If you have an 800 credit score, again, not the greatest on an FHA, but it's not a terrible rate on any program. You're not paying any points. So it's either okay to good, depending on where you fall on that spectrum. So I wouldn't worry about it too much.
All right, John, got a conventional loan in July for a primary home. Do I need to wait to get another loan, even if I pay it off before the year? So I'm assuming buying another property is what it sounds like to me. Do they have to wait, or do you read that a different way?
I'm confused by it because we're in July. So did you just buy the home? So you just bought a home, and do we need to wait another year to get another loan? No, there's no requirement on waiting to get another loan. If you're going to buy a second home, you're going to buy an investment property, any and all of that. But if you bought this owner occupied and you're saying, oh, in August, I would like to buy another home owner occupied, you're going to have a spectacular story as to why you didn't lie to the first lender that you just closed here in July. And if it was a year ago, July, that story can be much less compelling than if it was a month ago, July.
Good, good. Bits of interest ask, long term, I want to build a natural pool fish pond on the property we're buying. It's going to cost a lot. How does it affect resale value and other things like taxes and insurance? So I'm going to start at the end of that and say taxes and insurance, not going to affect you at all, really. It shouldn't really have any bearing on either of those.
It can increase your assessed value. When we put our pool in, we got reassessed for it.
But I'm thinking a little fish pond. Yeah, I'm thinking.
He's saying natural pool fish pond, and maybe I'm jaded here, Jeb.
You think a lake?
I didn't know this, but one of the channels that I watch, guy builds a barn dough, and they built a lake in their backyard. They dug it out, and the kids are swimming back there. They put a diving board, all sorts of stuff.
Yeah, if you're big enough to swim in, it's going to it's going to assess your value. I mean,
you're thinking a small pond.
I'm thinking koi pond.
Okay.
Like is what I'm thinking. I mean, I see them on properties and you can tell me if I'm wrong, bits of interest, but if it's that sort of thing, I don't think it's really going to have an impact as much on the taxes and the insurance. As far as resale value, it's one of those things that to each his own. To you, it might be the best thing ever. To some buyer buying it, they're like, I'm filling that thing in. I don't want to have fish. I don't want to have to deal with that. So I don't know that it's going to increase your value unless you have a buyer that specifically wants I think koi pond. I might be completely wrong. You might be doing salmon or something crazy out there. So you can tell me. But if it's that, then I think, it's
swimming pool built like a koi pond. So just what I told you, I did not know this was a thing. But I saw this thing. They built a lake in their backyard that it was like a koi pond.
20 foot by 40 foot. Yeah. So probably going to affect your assessed value a little bit. Not sure where you're located. That will obviously play an impact there.
He's in Kinston. Have you ever heard of it?
I have. If they don't even do taxes. I think it's probably you could just do whatever you want on your land. Nobody has any idea what you're doing on your land. So resale, again, I think same thing, right? You got to find somebody that's interested in that sort of thing on a property. I'm sure there's definitely people out there. Does it add value? I'm sure it could for the right borrower. Tough to say for me because we don't have anything like that out where I am for the most part. Just, everything here is smaller, not everything, but the majority of homes are smaller lots, tract communities, that sort of thing. So I'm probably not the best person to ask. Ask your agent what they think, because that could be, they could be a better source for you. North Texas. So in North Texas, it's,
I think it's a thing there because I think the video I was watching, I think they were in Texas also. It might have been Arkansas, but somewhere.
Did you watch a YouTube video where they did this and now you want to do it?
Now you want to use it. My kids would love that. I'm going to dig one of those in my backyard.
There you go. Let's see. Josh, what are the benefits of a USDA loan?
The biggest benefit. So what are the second part of the question? What are the rates like compared to a conventional? Just like FHA and VA, they're better than conventional. But they do have an upfront mortgage insurance premium of 1%. They have a monthly mortgage insurance premium of 0.35%. So if you're buying a house and you are beneath the USDA limits of income and you're in a USDA eligible rural area where the home is eligible, you would always pick USDA over the FHA, even if for some reason you wanted to make a down payment, because first of all, no down payment required. Otherwise, you have 0.2 lower mortgage insurance, 0.75% lower upfront mortgage insurance premium. So they're very similar loans. The underwriting is going to be tighter on USDA. Every time we say something like this, Jeb gets a call from a USDA rep saying, hey, I watched your video and that's not true. We'll do. And the reality is they may do that. But lenders in the real world, it's a little bit tighter. It's not a tight loan. It's not a hard to get loan. They're a little tighter on DTI, a little tighter on credit scores than an FHA. But other things being equal, if the property and you were eligible for both, the USDA is a great option.
All right. Willing has an additional question here. With so many zonings within a county, which ones are the key ones? Changes per county? No, I'm back. Where you are, what it's called. But for most, like for us here in Orange County, California, R1 is what you can build a residential one home on a lot, right? That's what R1 is. R2 is 2, R3 is 3, R4 is 4, so on and so forth. Once some neighborhoods don't want to see R4. Like you don't want R4 there because, that means somebody can build a 4-unit building across the street from you. So depending on what you're looking for in a property will decide which zoning is right for you. Investors like R2, R3, R4. Most people buying homes today are looking at R1 properties. So hopefully that helps.
And Jeb, the ones that can get problematic for you, if it's mixed use that allows commercial, that allows industrial, some lenders can come across problems with that. And if it's pure commercial, what you'll have a lot of these properties, like you go down Main Street in a town and you look at all these little houses and they have businesses in them instead of residents, then a lot of those now it's been changed to a commercial zoning. And in that instance, many times a lender will require you to get a rebuild letter. Okay, cool. You have a residential structure in a commercial zoning area. If it burns down, if someone drives their truck through it, can you rebuild it as residential?
Exactly. So 33 into this video, I'd like to take a minute and ask a favor. If you find any value at all, we answered your question. You just like looking at Josh and I, you're ready for the video that I'm going to play later. Do us a favor and hit that thumbs up. And if you haven't checked out the Educated Homebuyer podcast channel, do us a favor and check out that as well. But we appreciate the support. And with that, we're going to answer another question here. Are appraisals limited to homes sold within a certain time period or within a certain distance? Do similar single-family homes appraise differently in an HOA versus in a mixed zoned area? So the easy way to look at this is appraisers are trying to find as comparable of a home within a time period as close to the property as possible, right? That's the ideal. I think most companies, most people overseeing appraisals want you to stay within 90 days, right? So the more recent, the better. Can go out as far as 6 months in some cases. And when you can't find property, maybe even further out and you adjust for time, that sort of thing. The same with distance. Ideally, you want to be within a mile of a property in the neighborhood, really, if you can be. That's a comparable home. Model match is even better. But when you can't find those, you're able to go out and adjust for those things if necessary. And when it comes to HOA versus mixed use, in California, there's no adjustment for an HOA. If a property's in an HOA or not, what you're adjusting for is the home, the condition of the home, the size of the home, the lot square footage, the square footage of the property, all of that stuff. HOA does not play a part in these adjustments. Now, maybe if you're in Beverly Hills and 90210 and you pay $2,000 a week for HOA dues, then maybe there's an adjustment. But I don't think that's the case for most people.
R.I.P. Shannon Doherty.
Did she die?
Yeah.
I had no idea.
I think the show was cursed. We got Luke Perry first, and then her. This 50-year-olds.
I had no idea.
50-somethings are not supposed to leave this earth.
No, that's when did that happen?
Last weekend. Lost in the shuffle of other more important events.
Yes, there we go. Got it. Maybe that's why I didn't see. All right. I think I knew says if you lock your FHA rate, I'm just going to cancel FHA out. Say if you lock your rate and a month later rates improve significantly, are there options to obtain the approved? What happened there?
Is only Mr. Jeb freezing, or are we both freezing?
You just froze.
Is it only freezing here? Okay. So I knew the question you were reading, but you locked up there. So is there an option after you lock a rate? Yes. The market is going to have to move a fairly decent amount. And what is that? More than 1/8%. If the market only drops 1/8, you lock it at 5.75 and it goes to 5.625. Lender is going to expect you to honor that lock, because if it had gone up to 5.875 or 7.875, they were going to honor that lock. Now, on the flip side, if we get a 3/8 move from 5 3/4 to 5.375, they're going to offer to renegotiate that with you. You're not going to get all of that benefit. So it is a little bit of asymmetrical risk to the lender versus you, because they don't want the fallout if rates move a ton in your favor. So from that perspective, you can generally renegotiate a lock if the market moves a certain amount, but you're not going to get all of that benefit. So when you lock the rate, make sure you go ahead and ask your lender, hey, rates have been trending down. If I lock today, what is the renegotiation policy? How much does the market have to move? And how much of the improvement do I get if I do qualify for a renegotiation?
All right, good stuff. I guess I'm the only one freezing for whatever reason. It's amazing on the same internet, and that's what it is. And I have no tabs.
Vern says it's both of us. Vern says both of you dummies keep freezing.
Yeah, I don't know. That's where we're at. So anyway, apologize for any freezing there. There's nothing we could do. We've had the Frontier out here more times than I can count. So it's lost in the shuffle. We're never gonna have good internet. Let's see, Josh. There was a question that I saw that was.
Let's throw a comment here. Bits of interest piped in on that appraisal issue and says, hey, my appraiser pulled shit from last year to find similar ones. Market changed a lot since then. It did. And they most likely had to make a time adjustment in there. Whether the market's going up or the market's going down. If there is a lack of comparable sales, they're going to pick the most comparable home, the most near home. They're not going to take something less similar and then adjust for 3-bedroom difference in bed and bath count or 1,000 square feet. They're going to take the most similar home and do a time adjustment. And they're going to have to support that time adjustment of the market moving up or moving down since those older comparable sales had closed.
All right. I don't know where the question that I had was, Josh, but this one is one that, people want to believe is going to happen and possibly, but the interest rate on my home is 6% right now. Do you believe rates could go back to 2%, Josh? 2%. Do you believe that? Could it happen?
Could they? Absolutely. Absolutely could.
The likelihood.
There's a lower bound on interest rates, and I don't know where that is. It's probably somewhere in the 1 to 1.5% range. And we can say that because with some VA loans, people who are willing to pay some points, we closed a couple under 2%. So 2% is not the lower bound. Somewhere between 1 and 1.5 is as low as they can go, and anyone would be willing to lend money on a mortgage. But important thing that I like to point out to everyone. People like to say, we had this 40-year bull market in interest rates from 82 to 2022, and that's over. We're never going to see that again. We had a very strange time there in 2020, 2021, where we overstimulated the economy while we greatly constrained supply chains. That will work its way out over time. And I believe the bigger term pictures, issues that are playing out will continue to come back into play. And if so, Jeb, here's what I like to tell people. 2019, late 2019, early 2020, pre-COVID, we were moving into the low 4s on conventional loans, high 3s on government loans. So people don't want to remember that and say, hey, the only way we got rates in the 3% was with QE, whether we had that QE in 2012, 2013, 2014, that pushed conventional loans to 3.625, or QE in COVID, where they were buying all mortgages. The federal government was buying all mortgages and most of the treasury supply, and that pushed rates down into the mid to low 2s. So people say, absent another giant round of QE, we never get there. And I say, we were working our way into the 3s without QE in 2019, and we could go again all the way to that lower bound. Is it something that's likely to happen in 1 year, 3 years, 5 years? Probably not, but 15, 20 years down the line, I do believe it's possible. I don't know, Jeb, my guy Lacey Hunt came up with his quarterly report that goes super Einstein whiteboard, old school, explaining all of the academic theory behind it. But I still believe that we're in a downtrend in interest rates in the big picture. And when we look over time, this 2, 3, 5 year period of elevated rates will be a blip on the screen.
Got it. In order to see rates back down 1-2%, you got to have, in my eyes, you got to have something big happening out there in the economy. Like if the economy, World War III happens, economy eats, just complete garbage out there. Nobody can get it. You could see rates drop pretty quickly.
And Jeb, I don't think you're wrong. I think you're right. But I think that's in the short run, meaning 5, 7, 10 years. If we're talking 15, 18, 20 years down the line, let's flash back to 1990 when rates were 9%.
I was 10.
and you talk about a 5% interest rate, people say, you're nuts. Rates are never going to be 5% again. But 20 years later, we were there. So when we talk longer term perspectives, they could organically get there without QE, but not in the near future.
There you go. Good stuff. So Josh, not a lot of questions left at the moment. So if you have
want us to go eat wings,
now is a really good time to get them answered. Jermaine asked this question earlier, just says, is 5.875 interest rate on FHA a reasonable rate? So Josh, good credit, bad credit, 5.75. Is that a good rate?
Let's just go back to the slides at the top of the show. Mortgage News Daily is reporting that the average 30-year fixed rate on an FHA right now is 6.29. So you're 0.5% below that. So it would be good under any circumstances. But if you have a lower credit score, it could be amazing. It could be great. But for a reasonably well-qualified FHA borrower, 5.75 without paying a bunch of points to buy it down. And Jermaine, I don't remember your earlier question. You may be buying new construction. I'm hoping that's not 5.75 with the builder paying, $10,000 to buy that rate down. 5.75 should be at some cost right now, but not a tremendous cost.
Yeah, and if that's your rate, like on your home that you have already purchased, there's not enough room in the market. If you're asking, is that a good enough rate to, where rates are to refinance at this time? So you have a solid rate. You're not to the point of refinancing at this point, just where rates are. So I think either way, it's a pretty good rate, regardless of how you look at it. Josh, we're at the end of the show, 17 minutes early.
17 minutes early.
We got there 17 minutes early. Guys, if you have questions, put them in the chat. Now is the best time to get your question answered because there's not a lot of them in there.
And remember, with the referral link at the bottom, if you want your pretty picture with your beautiful new home at the beginning of the slides, all you got to do is connect with us, and we'll make sure we make you internet famous for at least 30 seconds.
There you go. Bits of Interest says, I need to look up recreational ponds after this, and he'll want one. I've seen them. I just didn't know. I didn't think that's what we were talking about. I thought, you're going to build a pond that has fish in it, and I'm thinking, I see those, on occasion, koi ponds, but you're talking.
Whenever I've seen a pond,
you're not talking about. You're talking a damn pond, not like a small swimming thing for fish. Like you could raise fish out there, and maybe that's what you're going to do. Maybe you're going to raise fresh salmon, fresh koi fish.
Edgar popped in with a real good question.
I don't want to do the whole rate thing, Josh. I got this rate. Is it a good rate?
He's not asking about a good rate.
Yeah.
He's talking about, is there a point soon where he can go to a conventional and get rid of his PMI? So on an FHA, it's going to be on there for the life of the loan. So the only way to get rid of that mortgage insurance is to switch over to a conventional. So if you're at 5%, unless you got this, I think he said 2 years. So 2 years ago, mortgage insurance on that was 0.85%. So let's just call it a 5.85. You would have to see conventional rates at least 1% better than where they are right now before you would make that move. And that would just get you to the same payment. So realistically, we want an improvement. You need to get to a conventional loan somewhere around 5%. And if you bought 2 years ago, that home has to have gone up enough in value that the conventional loan doesn't have mortgage insurance. So I wouldn't count on it anytime soon.
Let's see. Christina is. Click on it. I can't get. There we go. Elva is asking, what's a good cash on cash return for multifamilies in OC? So Josh, in order to buy a multifamily in OC,
you need a couple $1 million to put down.
Pretty much. I mean, if you wanted to buy a decent 4-unit right now in a decent area, you're spending minimum $2 million. I mean, yeah, you can find them out there for less expensive, but I mean, even then you're spending 1.4, 1.5. I mean, so cash on cash return, really difficult in this market, honestly, depending on where you're buying in Orange County. But what are your thoughts on the question, Josh? What kind of return are you looking?
It's going to be minimal. Just to get to break even on 4 units, you're putting a big down payment. So to get a cash on cash return, you could have a negative return, in terms of qualifying for the loan. Whether you qualify for it or not is a whole different animal, but minimal, because you're going to put a very big down payment. So again, let's say 4 units here in Huntington Beach, a not top of the line area, Jeb, is $2 million. So if you put 30% down, you put $600,000. You'd be lucky to get any return on that. You You might make $10,000 at the end of the year. 10,000 on 600 grand. I can find better places to put $600,000.
Good stuff. Jermaine followed up and said, it is new construction. It is a $10,000 buy down from the lender. So is that 5.875 or 5.75?
It was 575, and I would just make sure that that's the most recent number that they've given you. It sounds about right, because 575 is actually a really good rate. We just told you, if Mortgage News Daily says most lenders are in the 6.25 range, to go from 6.25 to 575 costs about 2 points. So if you're buying a $500,000 house, that's 10 grand. So it could be accurate, but as Jeb said at the top of the show, we've seen some nice improvement Thursday, Friday of last week. Make sure that's where we're at. And if you're comfortable with it, based off of that down channel and us possibly making a run all the way to the bottom of it, or probably making a run all the way to the bottom of it, hold on a little while longer. A shorter lock, you could either get it cheaper or get a lower interest rate.
All right, good stuff. Elva follows up and says she was thinking more like Santa Ana. So even Santa Ana, 4 units, you're spending probably 1.5 in this market. Unless unless it needs to be completely remodeled from stem to stern, everything in it. I don't know, Josh, am I wrong with that? I haven't looked at multifamily in Santa Ana in a while, but
they're just expensive.
Everything's
everywhere.
expensive. Yeah,
everywhere.
I know Long Beach has some that are a little bit less expensive, but even then, you're definitely over $1 million, and it's very difficult to get a break even without putting 40, 50% down on some of these things.
I'll say this, Jeb, the only time that it would make sense anywhere in Southern California or most of the high price markets in around the country right now is your friend at the gym who got a distressed property that we had multiple vacancies, needed a bunch of work. Yeah. If you can get a discount on the purchase, so that $2 million property, I'm picking it up for $1.5 million. I put $200,000 of work in it. So I'm already sitting on $300,000 equity. I'm still gonna have to put a big down, but now you're getting both the cash on cash. You have a longer term investment that you built some sweat equity into. For me, I would love to add more real estate. Jeb would love to add more real estate to his portfolio. The only way it makes sense right now, the only way you can pencil it and have any type of return that makes sense in Southern California is getting a distressed property off market.
Yeah, and before I answer more questions, I'm going to ask a favor, not to like and subscribe, but we would appreciate that too. But Elva asked where we're going for wings. So Josh did a deep dive. So we used to have a wing spot that we would go to every Wednesday, Wing Nuts, Costa Mesa, fantastic wings. They couldn't run a business. They went out of business. With that, Josh went down a rabbit's hole today to try to find, he went to Reddit, for God's sakes, to try to find wings in Orange County. So we want to know if you're in Orange County, where should we go for wings? That's what we're asking. So let us know in the comments where we should go for wings. That's what we want to know.
The best advice that I got.
No. Let's see what they come back. Let's see what they come back.
I want to ask. I want to know if influenced. I want to know if anyone's been to this.
You're going to influence their decision. Let's let them come back, and then if somebody says it, then you can confirm.
Okay. So if they don't, then I'm going to specifically ask if anyone's been there.
Well, if they've been there and they don't list it, then obviously it's not that good. But
maybe they forgot. Maybe they forgot that amazing wing experience.
Well, there we go. Julio says, is a townhome with an HOA a good rental? I'm thinking on selling it and buying a single family that allows me to build an ADU in the near future for my parents to move in with me. Is it a good investment? It can be. Sure. It depends on what you owe on it, how much rent it can bring. I have several clients that have townhomes that are great investments for them, but it all depends on how, the cash flow, what your goal is with that property. So it can be, or it can't be, depending on what type of property it is. Buying a single family, doing the ADU is awesome. If you can find the right property to do it, it makes sense. Also understand how much it's going to cost you to build an ADU. I think a lot of people underestimate the actual expense of building that, the permitting, everything that goes along with it. So just make sure you're factoring all of that in when you're trying to make that decision. Josh, we had a question here a moment ago asking about buying, buying. Of course, it's the educated home buyer, but say, are there risks with buying a home that had prior fire damage? It was repaired 25 years ago. So Josh, if you were looking at a home that was repaired 25 years ago, would it still be an issue for you today? And with that, what are the big things people should pay attention to on fire damage?
25 years ago, most likely one of the owners in that interim 25-year period would have discovered some sort of a problem. Any odors would be gone since then. You can have your inspector inspect any portions of the home that are visible. You can't do a destructive inspection, ripping drywall and stuff off, but they can go up in the attic. They can look at what rafters look like. I would think it would be highly unlikely that 25 years later there's a problem or an issue with it. But you see more home inspections than I do, Jeb. What are you thinking?
25 years, I think you're probably okay. I mean, where you want to pay attention is like attic space. If there's a crawl space underneath, you want to go under there. That's where the damage, a lot of this stuff is. The structurally that would impact, the house, like in a big area. But like you said, 25 years has gone by. Find out where the fire was, and that's where you pay attention to, right? If it was in the living room, then pay attention to the living room. If it was the whole house, a lot of it was probably rebuilt, but I'm assuming an insurance company came in and paid for it. And so if it's the same owners, see if they have receipts, see if they have proof that who did the work back then, what was actually done, what's the scope of the work, because all of that stuff could help you making the decision. Bits of interest ask when we're moving to Texas, like the other transplants from Cali we see here. So funny enough, I went to a meeting for my son, one of the sports teams he's on, this past weekend, and met someone who's moving from Dallas back to here. From here, they were from here, moved to Dallas, and now they're back because they were like, just can't do the weather. It's just it sucks. So I'm with that guy. I'm with the guy that says I'm here for the weather, and for that, it's going to get me really hard to get to Texas.
I love Fort Worth, Jeb. Great restaurants, entertainment. You can go to
great restaurants here too, Josh.
You can go to see the Dallas Mavericks, not too far away. The Cowboys, everything. So what I'm saying is, it's a world-class city with all of these wonderful options. And when I look for about $500,000 less, I could get a home even nicer than mine. But then they showed me what the property tax bill was, Jeb. And I said, so if I pay cash for this home, I'm going to pay $35,000 a year for the property taxes. I don't think I want to do that. And they always say, but there's no state income tax. I said, well, I'm old. In like 10 years, I'm not going to have a lot of earned income, but I'm still going to be writing a $35,000 check every year for my property taxes. So I'm out.
So like a shark, I'm out. Yeah. So, I mean, Texas is great. The land, all the things that Josh mentioned, but I'm here for the weather, man. I've been in California now my wife, her family's here, adds a whole different element into potentially even wanting to leave. But, I've got friends. I've got a lot of friends in North Carolina. People move to North Carolina every day. They're like, this is the greatest place on earth. It is, like 6 months out of the year. There's places where it's better, like 9 months out of the year. You can go to Arizona, St. George, Utah, or Southern Utah. It's the weather's great there 9 months out of the year.
It was
I'm looking for 100%, baby.
The other day,
I'm looking for 100%. And over the last 2 years, we haven't had 100%. We've been batting like 25%. Now we're starting to creep up a little bit. We're getting better. Josh.
We got no answers on wings. No one in Orange County had a suggestion for where wings are.
I'm telling you, it's a shame. It's a shame. That tells you there's a market. Either there's a market for building a place, which I think is a fantastic idea, pizza and wings. It's the only two things you serve. Don't serve anything else.
Waffles and wings.
Oh, Jesus, I'm out.
Waffles.
You're by yourself. Wings. You're out.
Okay.
Can you build an ADU in a community with an HOA if the lot is big enough? So the state says yes. The HOA probably says no. So, my understanding is that the state rules supersede the HOA rules in some of these. Now, different state may be different, right? I'm talking California. So with that, tough to say. I mean, you can do garages now in California. You can do a lot of things that fall underneath that. The HOA would have a really difficult time, I think, fighting it, but I think they probably would, depending on the situation and the circumstances. So, that's what you got to pay attention to. Unfortunately, there's not a clear answer at the moment that says. I'm sure they all say no HOA wise, where the state's saying yes. So somebody's going to do it. There's going to be a lawsuit, and at some point that will be a case that they base everything else off of, just like everything else. So, anyway. Josh, where are we? We're at 56 minutes. If you haven't done so already, hit the thumbs up. And Homer doesn't even eat wings.
I just pushed the button, and I'm asking if anyone has been to Santora's in Mission Viejo. It's supposed to have spectacular wings, but it's a long way from my house to Mission Viejo.
You know, I don't know. Why don't we ask Jimmy and Sarah? Jimmy, Sarah, have you been to Santora's?
Can you run over and test it for us if you have not?
Yeah. Well, better yet, can you just get them and bring them to us? I mean, with DoorDash, Josh, you should be able to order these.
Yeah, that would be like a $900 DoorDash. The guy would show, give me $900 and you can have your wings.
Dang, that's a drive, she says. Yes, you guys are killing us tonight. It's been low attendance this evening. You know, peaked out at like 80-something viewers. Not a lot of questions. You people clearly don't want to see us, Josh. So I'm going to play a video.
You can play us out. Play us out with the video.
You know, Josh, we might end it right here. This is Josh and I back in 2014, as I mentioned earlier. This is a video you should not watch. I'm just being completely clear, but I thought I'd put it up here just to see what it is, and we'll go from there. So, my number one question. My clients often ask, once I have a pre-approval letter, can I make an offer on a property and be sure that I'm truly qualified?
Well, the short answer is yes. Once you have a pre-approval
I love that. Well, the short answer is yes.
You can move ahead with confidence.
See, nothing has changed since 2014. You still need a pre-approval letter, and it gives you confidence in the process. Josh, can you get us to the right layout there?
Jeb's gonna work on a supercut of the greatest hits of our 2014 era videos.
I am going to get an editor to go through them because there's some fantastic stuff in there. I just don't know if you guys are ready for it. That's all.
We have some Winnebago Man style videos that we're going to turn loose.
That's too good. Anyway, we appreciate you guys being here. We appreciate the support. We'll see you next week. Until then, adios.
Amigos.
Your voice cracked.
My voice cracked. That was cool.